Funds. And every week we're taking the opportunity to bring you a variety of perspectives on financial markets, financial advice and developments here at NZ Funds. It is Monday, the 1st of November. Yes, that's the 1st of November at 9 a.m. This morning we welcome back to NZ Funds Connect's William Callanan. William, or Bill, has been instrumental in providing independent strategic advice to NZ Funds on geopolitical markets and the global economy for almost, I think, over 2 years now. Bill is a former portfolio manager and global macro strategist at macro hedge fund KiwiSaver. He also spent time at Soros Funds Management, Fortress, and Stan Druckenmiller's Duquesne. He is a member of the International Institute for Strategic Studies in London, a benefactor of the Oxford Institute for Energy Studies, and on the board of overseers for the Hoover Institution at Stanford University, California. Bill, wonderful to have you back on the webinar this morning. And look, there's heaps to cover this morning as we go into the fourth quarter of 2021 and looking forward to what 2022 has to bring. Perhaps we can start with you giving us a bit of an overview of the market and geopolitical setup, and then we can perhaps jump into the detail of different parts of the market as I'm sure the next 30, 40 minutes are going to go by in a flash, but let's see how we go.
Very good. Well, thank you, James, and what a pleasure it is to have the opportunity to speak to the 107 participants on the call. I'm always grateful to revisit and look forward to coming to Auckland as soon as possible. In terms of the world from a strategic standpoint, we think in a very disciplined fashion about frameworks. And what's the right framework for thinking about the complexity that exists within macro today? We think kind of the key variables here are 1, the trajectory of growth, 2, the trajectory of profit margins, 3, what's the outlook for liquidity, and 4, what's the credibility of central bank forward guidance. But I think the key, and I think what's most topical right now, is that we're in this final, what we think is acceleration phase, particularly in the commodity sector, where there's very, very significant supply and demand imbalances that are A, a function of COVID, and B, really a function of these consecutive shocks that the global economy has been experiencing. Starting first with COVID, then global supply chains and infrastructure, most recently the energy price shock that's hitting all of Europe and potentially into the United States. And then what we think are the 2 more to come, which we'll address at the end, which is a food price shock and then the interest rate shock on the aggregate stock of debt in the world. And what's very interesting, and why we use this phrase of the acceleration period that you're likely going to experience over the coming quarter, is when you have these very significant global macro imbalances, there's really only 3 ways to fix them. 1, incremental supply, 2, substitution, or 3, demand destruction. In the short term, when we think about the nature of these shocks, particularly energy, which is really driving the macro narratives at the moment, there's really no opportunity for incremental supply in the short term, particularly in the context of OPEC discipline. There's very little opportunity for substitution because it's kind of a race to the top between the different fuels. And so what you're really going to see is prices go to a level at which you experience demand destruction. And I think, an interesting metric in that regard is if you would take energy and metals spending as a percentage of global GDP, we're already about 15% above the highs of 2008. And so there's no magic number where demand destruction takes place, but what will happen is prices move very quickly to that point, and it's something you kind of know after the fact. But knowing that there's going to be demand destruction almost assures that there's a negative economic consequence. And that's one of the reasons why we think we're moving towards a more challenging growth scenario for next year. And this is also being accelerated as purchasing managers around the world move from kind of a just-in-time mentality to almost just in case. What happens if I can't get material, or what happens if I can't get it at the right price? And that's leading this acceleration. I think also creating very significant complexity around the growth outlook for 2022 is essentially we're seeing really the first true recession in China For Q3, there was negative quarter-on-quarter annualized GDP. We think for Q4, that's a possibility as well. And we will have 2 quarters of industrial production that's negative on a quarter-on-quarter annualized basis. And so where China's been 50 to 60% of the growth in marginal growth in global demand for a whole host of important commodities, and you're having this very, very significant reset in the growth trajectory. Instead of growing at 6%, probably growing at 3 or 4, that's a significant consequence in terms of the growth impulse globally. And why is that really occurring? Well, essentially, property is the bedrock of collateral in China in the same way that, treasuries are in the United States. And the expectation now that prices are going to fall, the value of collateral is falling, and that has a very, very significant impact on risk aversion, both from the bank standpoint and from corporates as well. And that weakness will be propagated into developed markets and EM markets alike. I think also geopolitically, when we talk about the liquidity question, is where does the Fed stand? And what's very interesting is the Fed's been so focused on reaching this idea of full employment that they've kind of missed a bit of the boat, so to speak, on the inflation that's coming through and the business cycle. So for many, many months, we've been big proponents that instead of inflation being transitory, that it would be far more persistent in nature. And so you have this convergence where at the same time, you're hitting essentially what is full employment in the United States. We have levels of job openings that are normally commensurate with, would be 2% employment, but, we're in the high 4s, closing in on 5. And at the same time, wages are actually starting to accelerate. And so we kind of use the term that at the very important Jackson Hole Fed meeting in August, Powell laid out 5 qualifications for where the Fed could pivot towards hiking rates. We call it, as a mnemonic to remember, the Jackson 5 as a way of keeping track of it. But essentially that excess inflation would be narrow and somewhat contained. And those areas where you saw excess inflation would be predominantly pandemic related and would cool quite quickly. So that's number 2. 3, that you would see a moderate wage growth, but in actuality, we're now seeing the fastest wage growth in the United States since the 1980s. The 4th is that inflation expectations would remain quote unquote contained in kind of the 2 to 3% range, or 2.5 to 3. But we're actually seeing consumer inflation expectations running anywhere from 6 to 8%, depending on the measures that you use. And then the final one is that structural disinflation would continue to be a theme. And so we think that at least 4 of those 5 will be significantly tested by the end of this year. And what that's driving is a narrative for central bank policy, not just in the US, but certainly the Bank of England, the RBNZ, the RBA, is what we call fast and fast. That we're going to see a much faster start to rate hikes, which is getting priced into markets. If you look at what occurred last week, a 10 to 12 standard deviation move in certain markets like the short end in Australia, but a much faster ending. And so all of that interest rate pressure will get squeezed into the front of markets, which essentially means yield curves can flatten and potentially invert, where that's foretelling of a potential recession or a negative growth impact coming. And so what we really come down to is many market practitioners believe that we're 18 months into a new growth cycle, i.e. that there was the COVID trough. But in actuality, if you view what occurred with COVID really more as a power outage or a contact recession that held the already economic cycle that was entrained in abeyance for a period of time, and we're actually now just resuming that trend, all of these metrics that you're seeing in wages, in employment, and inflation is much more late cycle behavior than early cycle behavior, which would cater to this idea that the Fed is significantly behind the curve. And so if you look at the traditional policy settings that the Fed has used historically for the current levels of economic metrics, the U.S. Fed funds rate should be anywhere from 200 to 300 basis points higher. So it just shows you how much this new framework of average inflation targeting may be distorting the price mechanism. However, what we see is kind of key to the trajectory for the next 3 to 6 months are these final two shocks. The next one, which is already emerging, is a food price shock. This is a function of record fertilizer prices around the world, which is a function of surging natural gas, Chinese eliminating the exports of phosphate, very high shipping costs, a 15% in seed prices increase, and then a 50% increase in diesel prices at least. So that mix couldn't be worse for the cost structure of let's say a U.S. farmer, and already food inflation is at the 2008 highs. So this is going to be a big issue because of the incredible weight that food has in emerging market CPIs, and we can already see that 60% of emerging market central banks are hiking interest rates by a much larger margin than expectations. And then the final potential shock is really what level of nominal rates can this incredible stock of debt in the world handle, right? And that's another reason why we may see the short end of fixed income in terms of yields moving up, but the back end having a tough time going higher in yields because of these concerns that a significant increase in interest rates. I'll give you an example. If the U.S. 10-year yield went back to 3%, over 45% of the U.S. discretionary fiscal budget would go to servicing interest. So this idea that the stock of debt is so large that if you reprice the interest on that it's just going to consume too much and crowd out private sector spending. And so that's another risk that is coming. And so one of the things that we're watching very closely is this incredible disparity between the recent fixed income volatility, but still very, very low levels of equity volatility, and how that's going to resolve itself at a time where growth metrics are going to slow sequentially. Corporate margins are under very, very significant price pressure because producer prices are rising much, much faster than CPI, and wage pressure is now coming through. And so are we setting up for potential reversal of the trends of 2021 in the middle to the second half of 2022? And what could the world look like if the Fed tapers and we see some of these hikes in the short end of DM markets come to fruition, but you get to the end of the taper and then you can't hike in the United States? So I think it's an incredibly complex environment, but that complexity also is breeding as much opportunity as I've probably seen in 23 years of macroeconomic investing, where incredible opportunities still remaining in energy, in agriculture, in fixed income relative value, in currency, and certainly in cryptocurrency as well. So there's no shortage of stones to turn over.
Well, Bill, it's a fascinating summary because I think there is a lot of discussion around this mid-cycle versus late cycle, and if you can convince yourself that we are mid-cycle, there's still some fantastic returns to generate across especially the equity space, but also across asset classes that aren't perhaps going to be as volatile as they were going into late cycle. Late cycle is a whole different story because
yes,
while you can make and generate some really decent returns in late cycle, often it's that last little hurrah before markets turn. It's also perhaps the most volatile and provides a difficult or more difficult roadmap to navigate. So when we think about the next quarter and perhaps into next year, what are some of the key signs that you think that equity markets will become more sort of late cycle volatility? Is it things like the confirmation that China's slowing down, or is it what are the other events that you specifically look at?
Well, look, I really think there's three. I think one, it's going to become quite commonly accepted, particularly after the data last night, that China's slowing at an accelerating rate. That's A. B, I think what's most important is where do we see the evidence of that slowdown in developed market PMIs, right? Particularly in Europe, will it be a tighter linkage? And then potentially for the United States as you move in towards the end of the year. I think that's absolutely critical. Secondly, do these yield curves continue to flatten and get on the cusp of inversion like we've seen here in short sterling in England? Because that's obviously not a great indicator for forward growth as well. And then, do we see this transmission mechanism from fixed income volatility into equity volatility, right? If we start to see that, and it's not just a rotation between growth and value, but aggregate equity market volatility is rising and stocks seem to not be able to get traction because corporate margins are suffering and earnings guidance is suffering. If you look for the Q3 earnings so far to date that have been announced, it's the largest number of pre-announcements of negative earnings on a forward-looking basis since 2011. So I think those are kind of the important metrics that we would be looking at that highlight risk.
Yeah, interesting. It's one thing that sometimes we forget in all these big picture discussions, that when it comes down to it, the global economy is made up of lots of different companies that are trying to earn and generate profits. And when you've got that sort of statistic around the biggest since 2011 of pre-announcement saying you're not going to meet their expectations, that's a pretty big red flag, I would have assumed.
But there's a very interesting dichotomy that's emerging, and I think it's part of this debate about what higher yields or higher nominal yields can do to the equity market in a strange way, where you see this flattening of fixed income market curves where all of the pressure is really 2 to 5 year, but actually 30 year may be coming down in terms of yields, or 10s may be anchored. That actually could be an environment where the NASDAQ actually holds in okay, and S&P X Tech does not, right? Because you're discounting those long duration cash flows at a lower interest rate. So there could be some very interesting tactical decisions that need to be made on tech versus non-tech. What kind of tech, versus the industrial spectrum, where if you're late cycle, then you need to be more cautious.
What happens to, and you touched on it in your intro, but what happens to interest rates when, at the moment, the Fed's going through a phase of tapering, and it happened in New Zealand already, where bond buying programs, etc., stopped, and then at the end of the tapering, the expectation is they then start increasing interest rates. Right. And you sort of touched on, actually, when they finally get to that point where they are ready to increase interest rates, they can't because of a big slowdown in growth. What's the effect of that? Like you say, on that actually could be have some positive attributes as well, I guess, temporarily, because the expectation of rates increases aren't there. But what happens to the longer end of the curve if at the shorter end they're not increasing interest rates, but because they can't, but yet there's still this inflation that's a bit more persistent hanging around?
Look, we're going to know in the next 8 months, unless the Fed shortens the taper, right? Does a higher order of magnitude and does 20 billion a month instead of 15, and then maybe the taper is 6 months, not 8. But let's say this: the big debate around QE, right, is that QE was intended to lower the term premium. And so what we will find is that in ending QE, does it elevate the term premium or not? Right? That's the big test that's actually coming in this removal of liquidity that would be commensurate with taper. So I think that's really the key question that the market's going to answer. I think in terms of the persistence of inflation, the progenitor of the persistence of that inflation was really the Chinese inflationary impulse, right? The Chinese PPI, went essentially from 0 to a 30-year record high in a year. And that created an incredible impulse to the rest of the world. That's now starting to come off quite precipitously. And so with about a 6 to 8 month lag, that's going to start to put downward pressure on developed market inflation metrics. And so you may have this situation where actually by the time the Fed finishes the taper, if it's an 8 month cycle, that right at the time they finish, actually you're at the leading edge of the downward pressures from the disinflation or the disinflationary process that is kicking in from China. So I think it's going to be quite tricky, and you're just going to have to watch how the long end reacts. Once the taper commences, does the term premium actually rise or not? If it doesn't, it really raises the stakes that if you get to the end of taper and can't hike, the secular stagnation arguments and the arguments that the global economy has so much debt that it can't tolerate higher nominal yields will become very entrenched. And then, not making a forecast here because, too many predictions ruin the forecast. But if that happens, you probably couldn't buy enough gold or crypto, because then it'll be very clear that monetary policy has become somewhat inert across a business cycle.
We could talk about crypto for the next hour, but I promise I'll stick to my line of questioning, which is the other interesting part of all this setup, and it's somewhat related, but also its own, I guess, unique market at the moment in a way, is energy. And we've had, as you touched on, this crisis of energy markets in Europe and potentially in the US. For those on this webinar, we have discussed the natural gas market, but perhaps you could give us an overview of what's actually going on there and how we can see it potentially playing out.
Look, what is occurring, these things always have their genesis in a consecutive group of decisions that are made 12, 18, 24 months ago. It's really a product of very, very significant underinvestment in production, underinvestment in infrastructure outside of the United States, but also the critical factor is that for the first time ever now, U.S. natural gas prices are linking to global gas prices because of the export of LNG. And so you're really creating a global natural gas market at a time where this combination of weather and underinvestment and policy decisions surrounding ESG and essentially, as we like to say, you're cutting carbon before you're building green, and they're going to happen at a very different place that leaves this gap where demand is quite strong. And so that's what's creating this historic price increase in markets where you're seeing regional competition to be able to get enough natural gas. And, it's not a political comment, but also the decisions that have been made in Europe of essentially ceding energy security policy to Vladimir Putin, would have questions surrounding the nature of doing that, basis the importance of Gazprom as an exporter into Europe, which until this new Nord Stream pipeline is brought online, the market is going to be incredibly tight. And so these imbalances are going to persist. And, where a $6 or a $7 or an $8 natural gas price would have been considered high in the past, you're now seeing $30, $35, $40, $45 gas coming into the winter time. And so the probability for spikes remains incredibly high because of also some very interesting climate teleconnections, like the breakdown of the polar vortex and things that allow cold air to kind of shoot down into different regions of the northern hemisphere. That creates incredible instability. And so how policymakers deal with this and how corporates deal with it, there's always a secondary and a third order consequence that's going to be one of these catalysts for quote unquote destroying demand, right? $35, $40 natural gas prices in Europe is leading to significant industrial shutdowns in fertilizer, right? And that fertilizer shutdown is going to then create higher food prices. So it's all as you move down the supply chain. But the other aspect is from ESG, this is kind of big oil's, as we call it, tobacco moment, i.e. The idea that it's no longer about fiefdoms of just increasing production. It's about capital discipline and returning cash to shareholders via buyback or dividends, and capital returns as the focus. And so you're not going to see the growth rates of production that we've seen in the past from non-OPEC nations in the future. And so the forward supply becomes quite tight.
And that's essentially shareholders telling these companies, look, we don't want you to put any more money into research or into production. Is that essentially what's going on?
Yeah, it's companies, but it's also governments, right? So the Dutch government, essentially issuing the equivalent of a Supreme Court judgment against Shell, right? These are big issues. So it's either shareholder action or government action that, in an environment of $80 to $85 crude, $80 WTI, $85 Brent, and $35 LNG prices outside of the United States, you would think that capital expenditure would be growing 30, 40, 50% year on year. looks like it's going to grow 5 to 7. So we've kind of disconnected from the prior elasticity that used to exist between higher energy prices equal higher capital spending. Now you have, as an example, U.S. oil producers are making $1 billion a day, right? But they used to spend 130% of cash flow on CapEx, and now they're spending 54%, and the rest is going to shareholders and buybacks and dividends.
So what about, I guess the old world, I don't know if you can call it that, but in the 90s, it was all about American bullying of the global world to secure oil. And all of a sudden, they found all these resources in the form of fracking, which meant they became global exporters of oil.
Yes.
Is that the end of fracking, or are these fracking resources going to be put back to production? It just takes a while. What happens in some of those markets?
No, I think for shale, which is what you're referring to, what you're going to see is just ongoing capital discipline amongst the major oil companies. And what these major oil companies are figuring out is that they're generating so much cash now that examples of some of the larger ones like Oxy and others, or even Royal Dutch, they could buy back their entire capital stock in 6 years at the current rates of cash flow, right? So that's how they're going to get paid in terms of stock price, not can we grow production 100, 200, 300, 400, 500,000 barrels a day. And so what you're going to find is the whole shale resource will just be much more efficiently managed for capital returns as opposed to growth for growth's sake.
So then the next, sequence after this energy shock, and you touched on it as well with fertilizer prices. And the reason I want to sort of labor this a little bit is because, New Zealand is sometimes considered a one-trick pony or one-trick cow, if you will, on milk production and dairy production. What does that mean for these sorts of commodities? And I guess, are we just going to see an ever-increasing rise in food prices and these food commodities because of energy?
Yeah, look, I think it's a combination of energy, of fertilizer, of shipping, of seed costs and some of the input costs of equipment, right? Because supply chains are in such disarray. So all of the major, you essentially have 85 to 90% of the cost inputs into agricultural production, which are experiencing, either record or near record price shocks simultaneously. And so the natural reaction to that is you shut in capacity, you have less output, or you cut acreage, or your yields on your crops suffer because you don't apply as much nutrient. And so the scary thing about this is if you use the UN Food Agricultural Office global grain price, you're at the 2008 highs going into this problem. So we're only at the leading edge of what's occurring, because what matters in the Northern Hemisphere is the crop season for what we call new crops. So for next spring with a late summer, early fall harvest. And so, you're starting to shock at record prices, right? With incredible things happening like fertilizer costs in the United States. They went up 75% last week for ammonia in a week, right? So this is an incredible shock. And so I think globally, what you're going to see are two interesting things. One, the food price shock coming, which will impact very significantly the consumer price inflation measures in emerging markets. But two things. One, fiscalization. We will start to see many countries do like what France is doing in energy and giving certain subsidies out. Because food can cause social unrest, i.e. Arab Spring 2.0, right? What you will likely see is a lot of governments fiscalizing that food price increase via subsidies, which actually lets prices run even higher. The second thing you'll likely see is food security, where large producers may not export any surplus that they have because they will want to keep it for their domestic population, i.e. what China's doing in fertilizer, what Russia may do in fertilizer or in wheat. So I think that's really the next cycle that's coming. And what's so interesting about it is The forward market is not pricing this remotely, right? Here you have the greatest cost shock in the grain market in 30 years in the making, and the market's only pricing a 4% probability that a certain grain is going to go back to the highs of 2020. So a lot of it is just finding that opportunity where things are the wrong price.
And I guess the reason why all these price movements and opportunities are fascinating is because at the same time, the equity market's at a late stage cycle. And so we can't just expect to grind out 15% returns per year every year like we did in the last 10 years, because all good things come to I'm not going to say end, and like you said, there's some tactical tilts perhaps you can make around tech depending on interest rates, but it's perhaps more uncertainty around equity markets and some of these commodity attributes, which will have potentially a negative effect on equity markets, actually we can opportunistically benefit from.
Very much so. Very much so.
Bill, the last thing I wanted to touch on before letting you go back to, I know it's Sunday night in London, and you've got trick-or-treaters to attend to, but one of the things that perhaps New Zealand investors think about is what about our biggest trading partners? And we've discussed China, but our other big trading partner is Australia, and they're certainly connected to China. And so without putting you too much on the spot, you spent in your career time in Australia and looking perhaps at some of those markets. Is the lucky country under a little bit of pressure, do you think, just top of mind because of what's going on in the slowdown of China, or are there attributes to basically their iron ore that means that demand remains pretty stable?
Yeah, I think there's a couple of different aspects. One, to touch on the geopolitical, the tensions between Australia and China will continue, right? And that's certainly impacting aspects of import-export balances and current account, particularly because of the export of iron ore. Now, a short-term offset is obviously LNG, but I do think it's still going to be very challenging from a current account standpoint. If you look at a China that goes from growing at 6 on a real basis to maybe 3, that's going to have a significant negative impact across the metals and mining space. So I think that's A. 2, this repricing that's occurred in the short end of the Australian interest rate market is very interesting, because does it have a transmission mechanism into mortgage rates, where even the RBA's work would indicate that a 100 basis point increase in interest rates could hit the housing market prices by anywhere from 25 to 30%. And so I think there's this confluence where domestic employment, domestic inflation is becoming very tight because of these supply chain issues. But at the same time, you have a more challenging external environment because of a China slowdown. So a place like Australia may be more vulnerable to central bank tightening into this exogenous and external slowdown.
Yeah, it's a fascinating one, because it's one that we don't want to get too caught up in, because there's lots of different drivers of the Aussie economy. At the same time, they moved through decades of no recessions, even through some pretty difficult times because of it. And so you have to perhaps look on the other side and go, actually, this could be a time when this country's under a bit of pressure, and it's not just property prices in China that's affecting it. It's the whole, I've forgotten the name of the new agreement that they've signed with I was about to say France, that they unsigned with France and signed with the UK and the US.
Yeah, the submarine technology, exactly. Yeah, and I think those are the kind of things that are more complex. And I think it's not an enviable time to be a central banker, i.e. the probability of there being policy error is very, very high, because you have an incredibly narrow aperture to navigate, right? Between growth versus inflation versus wage pressure, all of these dynamics. Particularly where you're coming off the zero bound, where if you're wrong and you hike, even if you do 50 or 100 basis points, and then you hit stall speed, it's like losing your engines at 1,000 feet or 5,000 feet, not 35,000 feet. You have no time to react.
Well, Bill, once again, always fascinating to chat about this week. There's a wide number of topics that we haven't even discussed, but really appreciate your thoughts and your input, and also just want to thank you as well for your input into helping us, I guess, navigate this transition of investment environment. Because without your thoughts, I think would certainly be one hand tied behind our back. So thanks for all your efforts and support over the past few months.
Team effort. All right. Well, thank you so much for the opportunity to speak again, and please follow up with any questions. I'd be happy to answer them offline.
Perfect. Thanks, Bill.
Great.
Enjoy your evening.
Thank you. Good evening.
Well, while we've been discussing with Bill, I thought I would hijack what Mark thought was a quiet Monday morning. Just to come in after Bill speaking, just to touch on the moves in Australian interest rates, Mark, just because it has been a big move, and Bill and I touched on it a number of times, and I perhaps thought we'd get you on just to put it into context what happened over the last week, just to, I guess, give a bit of insights for everybody on the webinar.
Yeah, thanks, James. I think it's probably also worth sort of separating it also into what's been happening in New Zealand, because Australia's sort of almost followed the New Zealand path. And very much New Zealand has, for probably the better part of the last 4 weeks, rapidly sort of increased short rates. So in New Zealand, the interest rate curve really is expecting the Reserve Bank of New Zealand to move interest rates at every meeting between now and the end of next year. So you're now at a situation where your 1 year rate, sorry, I'll get the rate on my screen. Sorry, if we look at, say, the 3 year rate, that's now 2.5%. And if you think of that relative to the OCR at 0.5%, that's quite a big gap. So the market has priced that in very rapidly, and so that 3 year, if we go back a month, that was about a full percent lower. So it's moved up 1% in 1 month. In Australia, the RBA has taken a much sort of stronger view that they needed to support the market and continue to stimulate. So they had been certainly haven't been talking about rate rises, and they have actually been continuing with their sort of, I suppose, their yield curve control, their bond buying program. Explicitly, they've been buying the 2024 bond, so their 3 year government bond. They've been buying that quite aggressively and keeping it as low as sort of 15 basis points. Essentially, they stepped away from that last week, really pushed by the market. And again, that's really can be read that as the Australian economy sort of reopens, the interest rate market is saying that in the bounce back in terms of growth will be strong, and that interest rates need to rise as a result. So from that point of view, you've seen Australian interest rates, they're still pretty low relative to New Zealand, but they've moved up sort of quite sharply from that sort of almost sort of beach ball type situation where they're being held at extremely low levels by the Reserve Bank of Australia, and now sort of moved up closer to their 3 years now, sort of rather than being sort of 15 basis points, it's around about sort of 70 to 80 basis points. So again, relative to New Zealand, very low, but you're seeing a process where that short end of the interest rate curve is starting to move up pretty rapidly.
So we're starting to see it in New Zealand and Australia, and I guess one aspect that we touched on as a team slightly, through the back end of last week is what does this mean for property? And I know today is the first day that there's some loan to value restrictions coming into force again into the property market in New Zealand. At the same time, we're at the moment at least pricing in 6 rate increases. This could have a detrimental effect on at least property price inflation, if not put a dent in some of the increases. And you might see, if it does stay, if these interest rate hikes do happen, which the jury's out whether they actually follow through with it. But if it does happen, it could put some real negative pressure on property markets and for that matter, obviously bonds.
Yeah, I think so. And to a degree, I'm actually of the view that I think some of the pricing in New Zealand has gone too far in terms of interest rates, because essentially I suppose the market is saying the Reserve Bank will get to an OCR of close to 3% by the time they're finished. Now, generally you have a spread over the OCR in terms of mortgages of 1.5% to 2%. So that implies a 5% mortgage rate. Those numbers, given I suppose the size of mortgages these days and the run up in house prices, would start to put some quite severe stress on parts of the more parts of the sort of property market, and will leave some people underwater in terms of their being able to sort of fund their mortgage interest payments. So that has potential to create some big challenges for the property market.
And last one before I let you get back to your Monday morning is bond markets. We won't have the end of month numbers for these, but in terms of the New Zealand government bonds index and corporate government bonds, any sort of idea of what the performance of those have been given such big increases in rates?
Over the last month, we are looking at, actually probably better to look at the 1 year number, the 1 year and year to date. We're now looking at, say, the corporate bond index is down 5% over the last for year to date over 2021, and the government bond index in New Zealand is now down 7%. And if you're following that index over the last 12 months, government bonds especially have been sort of very challenged. They're now down more than 10%, just over 10% over the last 12 months. And the corporate bond index, a little better, is down sort of six and change. So if you've been exposed to those, it's been a pretty rough ride.
Great, thanks, Mark.
I'm just going to say, glad to say our portfolios are positive over that time frame, which is the way we want them to be.
Well, exactly. I mean, not meaning to individually bag other people in the market, but if you're a passive index tracker like a Simplicity, you are reporting to clients -8% in your bond portfolios at the end of October, and that is going to be a pretty difficult discussion to have in a portfolio that's otherwise supposed to be relatively stable. And so that's the realities of what happens with interest rates increasing. Cheers, Mark. Thanks for your inputs.
Thanks.
Look, the last thing we wanted to cover this morning is we're going to talk about our monthly review next Monday. Given this is the first Monday of the month, however, market's still open Saturday morning New Zealand time, so we're delaying it by a week for the end of this month. But suffice to say, it was a market of two halves for our portfolios. We're up really strongly halfway through October, given the investments that we have across the different spaces other than just bonds and shares. And you really saw some energy price movements really help some of our exposures, and also within our tech exposure. However, unfortunately, given the big movements in different parts of that market, unfortunately, the second half was as bad as the first half was good, and we ended up about flat for the month. What is really pleasing is a lot of the news flow over the weekend looks really strong for those positions. So when you're investing in things outside shares and bonds, it's not going to follow what's going on in share markets, but it does mean that we are set up nicely for the rest of the year, and we're extremely excited about some of the portfolio positionings, especially around what's going on in natural gas and the polar vortex piece we wrote around the weather. It's not often I've written about weather. Weather is certainly not something that's overly exciting in general terms, but it is at the moment given the investments that we've got. And we're not looking for Arctic weather. We're just looking for a slightly colder winter in Europe and the US, which will really be an interesting outcome for some of the investments within the portfolios. Now, not trying to overplay it in the sense that colder weather, for the normal consumer, hopefully they won't feel the difference, but it might just mean that they might just mean that their heating is turned on for slightly longer in the morning and the evening. But that has a profound effect when you've got such a shortage of supply, as Bill was discussing. So on that basis, we will discuss in more detail the performance from October next week. But suffice to say that looking forward in November and December, we've got some really interesting events to play out, and really excited in terms of how the portfolios are positioned. If you've got any questions on what Bill discussed, please do follow up. He's more than happy to answer any questions that anybody may have. So do let us know. And any questions around the portfolios or interest rates that Mark quickly discussed, let us know. Otherwise, looking forward to discussing things same time, same place next week. Have a great week, everybody, and enjoy what looks like, at least in Auckland,